Why crypto is better than bonds? As the world progresses, new investment opportunities open up. Crypto and bonds are two new potential investments that have opened up in recent years. So, which is better? Crypto or bonds? Please like, subscribe and turn on the notification button to keep supporting our channel. 1. Compare and contrast investing in cryptocurrency versus investing in bonds. It's no secret that cryptocurrency has taken the world by storm. In the past year alone, the total value of all digital currencies has grown exponentially, with some estimates placing the total value in excess of $1 trillion. This unprecedented growth has led many investors to ask whether they should be investing in cryptocurrency or bonds. To help answer this question, let's take a closer look at each investment option and compare and contrast their key features. Cryptocurrency. 1. Cryptocurrency is a digital or virtual currency that is backed by blockchain technology. 2. Cryptocurrency is decentralized, meaning it is not subject to government or financial institution control. 3. Cryptocurrency is highly volatile, meaning its value can fluctuate significantly in a short period of time. 4. Cryptocurrency can be used to purchase goods and services, but it is not yet widely accepted as a form of payment. Bonds. 1. A bond is a debt security that obligates the issuer to pay the holder a fixed amount of interest over a set period of time. 2. Bonds are issued by governments and corporations in order to raise capital. 3. Bond prices are typically less volatile than stock prices, meaning their value does not fluctuate as much in the short term. 4. Bonds can be traded on secondary markets, but they are not typically used to purchase goods and services. Now that we've seen a side-by-side comparison of cryptocurrency and bonds, it's time to make a decision. If you're looking for an investment that has the potential to generate exponential returns in a short period of time, then cryptocurrency is a good option. However, if you're looking for a more stable investment that provides a steady stream of income, then bonds may be a better choice. 2. Why might someone choose to invest in cryptocurrency over bonds? There are many reasons why someone might choose to invest in cryptocurrency over bonds. For 1, cryptocurrency is much more volatile than bonds, meaning that there is the potential for greater profits. Additionally, cryptocurrency is not subject to the same regulations as bonds, meaning that investors have more freedom when it comes to how they trade and invest. Finally, cryptocurrency is still a relatively new asset class, which means that there is more potential for growth than in more established markets. 3. What are the risks associated with investing in cryptocurrency? If you're thinking of investing in cryptocurrency, you'll need to be aware of the risks involved. Cryptocurrency is a digital asset that's not backed by any government or central bank, and it's subject to wide price swings. If you're not careful, you could lose all of your investment. Before you invest in cryptocurrency, it's important to understand the risks involved. Here are a few things to keep in mind. 1. Volatility. Cryptocurrency prices can fluctuate wildly. In December 2017, the price of Bitcoin surged to nearly $20,000 only to drop to around $6,000 a few months later. If you're not prepared for price swings, you could lose a lot of money. 2. Fraud. There have been several high-profile cases of fraud in the cryptocurrency space. For example, in 2014, Mt. Gox, a Bitcoin exchange, filed for bankruptcy after losing 850,000 Bitcoins. These Bitcoins were valued at more than $400 million at the time. 3. Lack of regulation. Cryptocurrency is not regulated by any government or central bank. This lack of regulation makes it a risky investment. 4. Security risks. Cryptocurrency exchanges have been hacked in the past, and there's a risk that your Bitcoins could be stolen if you store them on an exchange. It's important to store your Bitcoins in a secure wallet. 5. Tax implications. Cryptocurrency is subject to capital gains tax. This means that if you sell your Bitcoin for a profit, you'll need to pay taxes on the gain. Before you invest in cryptocurrency, it's important to understand the risks involved. While there's the potential to make a lot of money, you could also lose everything you invest. So, approach with caution and only invest what you can afford to lose. 4. What are the potential rewards of investing in cryptocurrency? Cryptocurrencies are digital or virtual tokens that use cryptography to secure their transactions and to control the creation of new units. Cryptocurrencies are decentralized, meaning they are not subject to government or financial institution control. Bitcoin, the first and most well-known cryptocurrency, was created in 2009. Cryptocurrencies are often compared to traditional investments, such as stocks and commodities. However, there are some key differences that make investing in cryptocurrency a unique and potentially lucrative endeavor. For one, cryptocurrencies are often much more volatile than traditional investments. This means that they can experience more drastic price movements, both up and down. While this can make them relatively riskier investments, it also means that there is more potential for reward. Another key difference is that cryptocurrencies are not regulated like traditional investments. This lack of regulation can make them more susceptible to fraud and manipulation. However, it also allows for more innovation and freedom in the way they are used and traded. Finally, cryptocurrencies are still a relatively new and untested investment option. This means that there is a lot of potential for growth and change in the space. As the industry matures, we are likely to see more regulation and stability, which could potentially make cryptocurrencies a more mainstream investment option. Overall, investing in cryptocurrency is a unique and potentially rewarding experience. While there are some risks to consider, the potential rewards could make it a worthwhile investment for those looking to take a chance on something new. 5. How can investors mitigate the risks associated with investing in cryptocurrency? When it comes to investing in cryptocurrency, there are a number of risks that need to be considered. However, there are also a number of ways that investors can mitigate these risks. Firstly, it is important to note that cryptocurrency prices are highly volatile. This means that prices can rise and fall rapidly, and this can result in investors losing a lot of money if they are not careful. Secondly, there is also the risk of fraud and scams. There have been a number of cases where people have been scammed out of their money by fraudulent cryptocurrency exchanges or ICOs. Thirdly, there is also the risk of hacks and attacks. Even the most secure cryptocurrency exchanges and wallets have been subject to hacks and attacks in the past. This means that there is always the potential for investors to lose their money if they are not careful. Fourthly, another risk to consider is regulation. The cryptocurrency market is currently unregulated, which means that there is a risk that governments could crack down on the industry in the future. This could result in investors losing a lot of money. Lastly, it is also worth noting that the cryptocurrency market is still in its early stages. This means that there is a lot of uncertainty surrounding the future of the industry. This could result in prices fluctuating a lot in the future, and this could lead to investors losing money. However, despite all of these risks, there are still a number of ways that investors can mitigate them. Firstly, it is important to do your own research before investing in any cryptocurrency. This means that you should make sure that you understand how the market works and the risks involved. There are a number of online resources that can help you with this. Secondly, it is also a good idea to diversify your investments. This means that you should not put all of your eggs in one basket. Instead, you should invest in a variety of different cryptocurrencies. This will help to reduce your overall risk. Thirdly, it is also worth considering investing in a cryptocurrency indexes. These indexes track a basket of different cryptocurrencies, and this can help to reduce your risk. Fourthly, you can also use stop-loss orders. This means that you can set a limit on how much you are willing to lose on a particular investment. If the price of the cryptocurrency falls below this level, then your order will be executed and you will sell your investment. Lastly, it is also worth considering using a cryptocurrency trading bot. These bots can help you to automatically buy and sell cryptocurrencies. This can help to take some of the emotion out of the investment process, and it can also help to reduce your risk. Pros and cons of crypto. Pros. 1 can be used to purchase goods and services. 2 transactions are fast and cheap. 3 borderless. 4 decentralized. 5 can be used as an investment. Cons. 1 fluctuations in value. 2 not widely accepted. 3 security risks. 4 lack of regulation. Pros and cons of crypto. Pros. 1 can earn a higher interest rate than a regular savings account. 2 relatively low risk investment. 3 easy access to funds. Cons. 1 interest rates can fluctuate. 2 minimum deposit requirements can change. 3 access to funds may be restricted. Don't forget to like, subscribe and turn on the notification button so that you won't miss any updates.